Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklow,
And I'm Alex Collins.
and on today's episode, we're going to be talking about tax diversification, specifically when it comes to income in retirement.
Yeah, this is a follow up on last week's conversation where we were talking about efficiency and where this is essentially where to actually put your money to achieve the efficiency that we talked about last week.
So, before we dive into that, Mr. Collins, what are you drinking?
Today, I am drinking an old favorite, Mac and Jack's African Amber.
Yeah, that's a solid one. I think that was one of my first craft breweries that I drank when I moved out here. So,
For sure.
solid one there. I'm drinking Crushable Hazy IPA by Rubens.
Nice.
So 5.2 alcohol, which is really low for a IPA, but it's delicious, by the way.
The African Amber, unfiltered amber beer, clocks in at 5.8. This is it's one of my favorite beers.
Absolutely. So check those two breweries out, as Alex and I definitely enjoy them. So let's dive into today. So Alex, in our last conversation, we were talking about how most people, when they're looking at their portfolios, their investments, are really only looking at the gross return, not taking into consideration taxation.
Right.
Today's episode is okay. You are about to click into retirement. Now you're going to turn your assets into an income stream so that you can retire. And the question we always ask people is, how's your income going to be taxed when you get to retirement?
And most of the time we get just deer in headlights look back at us. You know, oftentimes we have the conversation around like, hey, how do you feel that taxes are now compared to 10 years ago, 20 years ago, etc. And the answer that we always get is, oh, they're worse today. You know, I want everything to be tax deductible because of where taxes are. So why don't, Ryan, can you go ahead and share your screen and let's go ahead and pull up the history of taxes?
Yeah.
Because I think that it's one of those things where people don't really understand the history of taxes in our country. And the other thing that I think is really super interesting is that most people don't hit the taxation, the marginal tax bracket that they're going to be in retirement until somewhere around their mid 50s, maybe even late 50s. And so what that means is that for the vast
let me
majority,
interrupt you real quick. You just said most people will not hit that highest marginal tax bracket in their life until they're in their 50s. The reason we say that,
their own personal highest marginal tax.
Correct. The reason we say that is when you're 25 years old, think back to our listeners right now. Think back to when you were 25 years old. What was the income coming in the door at that time? I'm guessing a lot lower than it is today, especially if you're in your mid 40s.
Or later. Yeah. Yes, absolutely.
And the same thing is true if you're in your 30s, right? It just holds true. And that's what most people don't look at. They're only looking at taxes today, and they're not thinking, oh, my income's gone up quite a lot in the last decade.
They're also like thinking about it from a standpoint of like, oh, I'm going to be retired. I'm not going to have an income. And reality is that the vast majority of your assets are still going to be taxable in retirement. Heck, even Social Security is up to 85% taxable in retirement. And so helping folks understand some of these things is critically important. And so just because you're not actively working, you're still going to have taxable income, especially if everything has gone into the traditional side of 401k where you're taking the deduction.
What we're going to get into here shortly, a little bit more details about that. What Alex asked me to pull up is the history of federal income taxes. And what you're staring at here is the dark green is the lowest marginal tax rate in that given year. And the lighter green is the highest marginal tax rate. And we're not going to spend a ton of time on this chart, but one year I always like to focus on is 1944-45, where the highest marginal tax rate at that year was 94%. And the lowest marginal tax rate was 23%. So the lowest marginal tax rate was 23%.
And Ryan, if you would, when 401k was invented in the 70s,
Right here, 1978.
we're looking at a 70% marginal tax bracket on the upper end and a 14% tax bracket on the lowest end. So from there, you can see taxes have come down considerably since the invention of the 401k.
To some degree. They're also, the tax brackets have changed, right? So that's another, like, getting into the weeds a little bit, right? Tax brackets change. So it's not exactly apples to apples as we're staring at this. The reason we're going over this chart to begin with is I think we forget what tax brackets, like highest and lowest, have been.
Right.
And this is the key ingredient, we don't know what's going to do in the future.
Right.
Right. So knowing this knowledge now we can go to, okay, what are tax brackets today? And more specifically, let me actually back out here, Alex. Our listeners, right? You're making choices as to where to put money today. And the vast majority of questions you and I get are, should I be putting money in a traditional retirement account where it's pre-tax money going in, where I get a deduction this year on my taxes? It grows tax deferred. And when I pull it out, it's taxed, and it's taxed at ordinary income rates, versus a Roth. And the Roth account is essentially, it's after tax money. So it's money that's been taxed today. It goes into the account, it grows tax deferred. And when you pull it out at past the age of 59 and a half, now it's tax free. And the overall question is, where should I be putting my money? And so we're trying to answer that question. And the answer is always around balance. Most people, like, the majority of their money is in that pre-tax account. Very few do we ever sit down with a client and say, oh, all of your money's in Roth. Like, we don't ever see that.
Right. Well,
so,
and like the other thing that's important to understand is, like, okay, if you're not going to reach your marginal tax bracket until your mid to late 50s, well, then ideal would say we put everything into Roth ahead of time, and then at that point switch. The problem is that a lot of those choices have already been made by the time someone comes to us, and so now we're trying to create balance when there wasn't balance to begin with.
So now let's look at, so we're going to look at this scenario one here, and specifically focusing on, well, actually let's still consider like today, right? You're not retired just yet. You're making $250,000 of income, right? Your marginal tax bracket's at 24%, Alex, right? That means that's the highest amount of taxes you'll pay percentage wise on your income, on some of your money that's coming in the door. And what's interesting is so many people come to us and they say, well, I'm going to be in a lower tax bracket in retirement.
Maybe.
And the answer is maybe. A, do the tax brackets change in retirement? Question number one. Question number two is, okay, of the 250, how much do you need in retirement or want in retirement? And so some people will say, well, I won't need to pay my mortgage, or I won't need to save any money. So let's just say you could wipe off 50 grand. You only need 200,000 in retirement. Well, I hate to be the bearer of bad news. That's still the 24% tax bracket, marginal. Right. So it would have to be more than $50,000 that you would not need to stay in the same tax bracket. And that's if taxes brackets don't change. Like, there's so many variables to that piece. And this isn't saying that you won't be in a lower tax bracket. This is just explaining how tax brackets work, so you're looking at it objectively.
Well, and like, okay, let's play devil's advocate for a second, Ryan. Let's say that you are able to wipe off more than $50,000 worth of taxable income, and you don't need that extra income or want that extra income. Like, okay, congrats. You went from the 24% bracket to the 22% bracket. Like, you saved yourself 2% in taxes, like, at least at a federal level. Now, every state's going to be a little bit different. Every state has their own taxation structure. In the state of Washington, we're lucky enough that there is not a state income tax, at least not currently. But it's one of those things where, like, helping folks understand, like, okay, cool, we're saving 2% in taxes. Might there be a bigger difference in whatever the change is, be it positive or negative, in tax brackets in the future?
Well, and that goes to our point now is, okay, so now imagine this is a income stream in retirement, right? If all of your money is going to come from that traditional 401k or traditional IRA where you haven't paid taxes on that money, this is how that money gets taxed when you pull it out. So if you needed $250,000 in retirement, this is how you're going to be taxed. That's $46,000 in taxes, right? And if you needed 200, just to show that, because we've given that example already. Oops. Now the $200,000, this is what that looks like. Oops, 201. So, right. So there's that 2% difference that Alex was talking about. But here's the key ingredient, and this is what most people don't take into consideration. What if you can get to retirement and you can look like this, where you still take the 250, but you've set yourself up in such a way that maybe only 175 of it is actually taxable.
Don't forget to hit recalculate on the left side, Ryan.
Yep. So here's the key ingredient between these two scenarios. Like Alex just said, whoop-dee, 2%, 24 to 22%. That's the marginal tax brackets between the two scenarios. What the key difference is the effective tax bracket. That's a 7% difference.
Well, and now it's the like how much of the income or the cash flow is subject to taxes. It's not that the effective or the marginal rate is dramatically different, but the effective rate is massively different just based on showing $75,000 less in taxes.
And how we do this is you're making these decisions today where you're putting your money. If all of your money's in the pre-tax account, you're really kind of stuck with scenario one. You haven't paid taxes on it. Every dollar you pull out is taxable at ordinary income rates. Oh, by the way, Social Security will be on top of this, right? That's something else, right? We're not taking in, well, we're kind of taking into consideration if we needed the full 250, but we have to take both sides into consideration. And so we have to understand when we can pull money from different accounts that are taxed differently, now we can do some version of scenario two, depending on our strategy.
Right. And so, Ryan, if you would, let's go to the guaranteed income calculator and show an example of where and how we might be able to go ahead and create some of this type of tax efficiency. So we're going to look at a 30-year time period. Let's just look at $1 million worth of, actually, let's look at $4 million. Trying to create that. Actually, 4 million is fine.
That's fine.
And like what we're going to be looking at here is an example of a 65-year-old taking into account. Don't forget to go back and throw the $4 million in the second. Yeah, yep. There you go. And so what we're looking at here is the cash flow created from a $4 million portfolio versus $4 million of income guaranteed.
We're using the same 24% tax rate, by the way.
Yeah. Same 24% tax rate. Now, the location of our money, like we may not be able to put all 4 million, or we may not want to put all $4 million into a structure that's going to guarantee us income, but go ahead and click recalculate and we can see the difference in terms of like this is showing net of taxes. And we're looking at significantly more than 2x the amount of net after tax cash flow simply by being able to take a different approach towards it.
Yeah, just real quick, just for those of you who are watching this, on the left side here, we're taking like an interest-only approach. Essentially, whatever return we've gotten in the portfolio, and I think I did a 4% rate of return in retirement. So they're scraping the interest off the top. So the $4 million grows by 4%. They take that 4% and then they pay taxes, netting them in this instance $121,600. Whereas if they were to have this money and they were to annuitize it, essentially turn on a guaranteed income stream to themselves, now they get $267,000 guaranteed for the rest of their life. And I know we want to show real quick the details of the scenario here. Really what the annuity kicks out is $287,000, almost $288,000. But you only owe $20,000 in taxes, which gets you net $267,000.
So it's an example where we get more cash flow, $288,000 versus the $160,000, and we actually wind up paying less in the way of taxes, at least at the beginning, $20,000 a year versus $38,000 a year. So we're able to go ahead and play both sides of that equation where we're able to have more income, more cash flow, and less taxation because a good portion of those dollars are a return of our own money.
Let's play. We want to put this back in this scenario we were doing over here. So going back to this tax scenario, what we just created was now 287,000 of gross cash flow guaranteed. And the taxable portion was 20,000, 287 and netted out 260. What was the figure, Alex? Do you recall?
So hold on. It was $20,000 in taxes. So
267. So
what 267 was that's not the taxable portion.
Oh, that's not the taxable portion. You're right.
So plug in 150 there. We're going to try and see if we can get down to the total tax being roughly 20.
I mean, you're just about there right there.
Right.
Right. This is still higher, but think about this. Now your gross cash flow is 287. The taxable portion is 150. How about having an effective rate of 8%?
Yeah. And you can see that we're slashing the rate of tax that is paid on all of the cash flow by being able to go ahead and have a good portion of that money come back to you income tax free. And there's like using guaranteed income is one structure. Using the Roth component is a different structure. There's no one solution. We're just trying to throw out a couple different concepts here. And really the big takeaway from this should be when we get to retirement, if we have done proper planning and created balance, we are going to have choice as to how much income. We're going to have choice as to how much of that income is taxable. We're going to have choice and flexibility with when and how we show our dollars as taxable to us.
Yep. So that was the purpose of, understanding where your assets are today and how they're going to be taxed when you turn it into an income stream, which now takes us to the question of the day, Alex.
Our question today is, how tax diversified are you as you're approaching retirement?
So head over to beerandmoney.net. And if you scroll to the top, there's a contact us spot at the top there. Click on that. And you can either answer this, or if you have questions from this, or you have another topic that you want Alex and I to talk about, that's a great spot to reach out to us, as that's where a lot of our topics come from. Look, we started this podcast to help you families organize your finances in such a way and take actionable steps so that you can feel confident, so you can actually spend more time with your family and less stress on your money. As always, we hope this episode is valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Pinpoint number 2024-175633. Expiration May 2026.